The topic of today's discussion is what are the financing constraints, if any, in bringing capital into the renewable energy sector, and we shall touch upon round-the-clock power, which is part of the storage story that is fast emerging. In the previous two sessions, we looked at the the risks inherent in energy transition and green hydrogen. That was the first workshop. The second workshop was focused on how do you stimulate demand, what are the policy levers, what are the financing levers, and other levers available to stimulate demand for green hydrogen. And today's workshop is focused on a very significant component of the value chain, which is financing constraints in the renewable energy sector. So welcome once again to all of you, and I'd like to welcome my special lead discussants for today. So Subramaniam from National Solar Energy Federation of India. Subramaniam's the CEO there. Sachin Vermani, who is the Senior Vice President at SBI CAPS, State Bank of India's investment banking arm. Rajiv Sadavartia, who's the Senior VP at Axis Bank. Mr. Amit Sengupta, who's leading the corporate finance division at Avada, which is one of the largest developers in the country. And Mr. T.N. Girdhar from Impactor, who's based out of London, also a senior corporate finance expert in the industry. So welcome to my lead discussants. We'll touch upon a number of sort of points this morning, but I thought perhaps if I can ask Subramaniam to kind of kick off the discussions on telling us what is the current installed base. Subramaniam, I know whilst you represent solar energy, but if you can broadly touch upon renewable energy as a as a whole sector, what is the current installed base, and for green hydrogen, what is the additional capacity the country needs to add, and what are the challenges you think the industry is facing? And after you, I'll ask perhaps Amit to talk a little bit on the same topic. So Subramaniam, over to you.
Thank you very much, Sanmit, and thank you to the Green Hydrogen Organization for inviting me here. I think we are now meeting at what one may say an inflection point in India's journey towards sustainable future. To give you a quick recap of what happened and where we are today. Today, India boasts of total installed solar capacity of 71,010 megawatt and another 43,000 megawatt of wind capacity as of August this year. That makes us the world's fifth largest country in terms of installed solar capacity and fourth largest in terms of wind capacity. While in the total RE sector, as a total installed capacity, we are now world's number 4. That said, our solar capacity has increased almost 20 times in the last 8 years, and now we are at 71 odd gigawatt. And our target for solar is around 280 to 300 gigawatt by 2030, which means we will triple our current capacity or at the very least and quadruple it in the next 7 years. So what we have installed as a country in terms of total electricity capacity since our independence, we are going to install this equivalent of quantum of only solar in the next 7 years. That is how we are looking at solar proliferation. Today, as you are aware, we have seen the evolution of trajectory in India when it comes to renewables. We started with wind separately, solar separately, and then there was transition. And today we are looking at renewables as an alternative to conventional sources while providing a firm and dispatchable energy. So today now the bids have evolved into instead of plain vanilla solar or plain vanilla wind to a more integrated dispatchable bids. We have seen one of the first bids before COVID, a huge response of that Seki's bid. Then during COVID, we had round the clock, we were one of the lowest tariffs in the world. Then that has been institutionalized by the ministry and the government. And today we are having every other bid is in one way or the other a hybrid or coupled with storage or round the clock, or in general a broader term would be firm and dispatchable. As a country, if you look at it, we have, on the solar side and the wind side, we've been in a position to achieve efficiency as well as price parity much ahead than it was envisaged. And that makes us eligible to talk about the green hydrogen and reducing the tariff of per kilogram of green hydrogen. Today, maybe a little bit more on renewables before I switch back to green hydrogen, is on how the market forces are taking over. India is, like I said, we are at an inflection point today. While most of our installations and demand has been driven by the government-based tenders and state-based procurement, we are now witnessing a transition in our energy transition from government demand to market-driven demand. So we are witnessing a huge a jump in corporate procurement and C&I procurement, not just for rooftop related procurement, but also they are tapping into the round the clock variants of renewable power also. So that is a very encouraging sign, and that demonstrates the resilience of the market, and we might as well start calling ourselves a developed market in renewables than what we were before 3 or 4 years back. Maybe a little bit on manufacturing today. I mean, back until 2010, 2011, we were one of the largest exporters. Then focus shifted on installation, and then we were predominantly dependent on our imports. But today, that tide is also turning, and we have two PLIs already in place, production linked incentives, coupling both of them together around $3 billion odd dollars for solar manufacturing. And with that, if everything goes well, India will be the largest hub outside China, or the second largest hub in the world for solar manufacturing, end to end, vertically fully integrated, with at least 100 gigawatt of module and cell manufacturing in the next 4 years, and 60 to 70 gigawatt of polysilicon wafer and ingot downward integration by 2026, 2027. So that is on the manufacturing side of solar. And wind, of course, we are one of the world leaders in manufacturing. Now maybe let's shift to the discussion today on green hydrogen. As NSEFI, we project if we have to achieve our green hydrogen production targets by 2030, we would require somewhere between 100 to 130 gigawatt of solar exclusively for green hydrogen. This is not coupling other allied renewable sources and variants of RE generation. And maybe on the little bit to establish the context, maybe during the discussion we can go deeper into it. We have, as a country, most of you are aware, we boast of one of the most comprehensive and thorough regulatory mechanism that has time and again helped investors reinstate their confidence in the market. We've always been in the top three of renewable energy attractiveness index. We've been number one for 3 years straight since last 3 years. And the checks and balances mechanism has always helped investors have confidence in the Indian side of things. On the solar side, over the last 8-9 years, we have attracted around $15-20 billion of investment. And by the way, renewables is 100% FDI in India. That has also helped us tap into affordable capital streams that can help us accelerate India's energy transition goals. And on the the projection wise, we need at least $200 billion to achieve our 2030 targets for solar and wind together. I'm not counting green hydrogen. If we add green hydrogen, it will be another $125 billion more. More or less, we are looking at including transmission, other infrastructure, and down the chain integration and distribution. We are closer to $1 trillion requirement for achieving our climate targets as well as our net zero goals. And this calls for utilizing new and innovative financial instruments. I think we can dwell more into that discussions today. But yeah, this is the overview of the sector as we speak.
Great, Subramaniam. So I won't go as far as $1 trillion. So let's whilst the number is absolutely correct, but let's look at the sort of lower hanging um, fruit as well as the immediacy of capital that's required. So let's put a figure at around about $200 billion that we need over the next 3 to 4 years, just on the RE side and perhaps green hydrogen as well. Um, where is that capital going to sort of come from is the main point of discussion today. So thanks for painting that picture, Subramaniam. Can I draw in Amit from Avada? Amit, do you concur with Subramaniam's sort of overall comments and the capacity enhancements and the capital needed to support the development of that?
Yeah, thanks, Sanmit. Thanks, Subbu, for giving us a very exhaustive view of the sector. I think at Avada, being one of the initial entities in our earlier avatar as Wellspun and subsequently Avada, we have sort of seen the sector grow and at a very pace. Also, as we have recently raised a fairly large round of capital, whereas the overall estimate that Subbu gave about the market is absolutely spot on. I think we are today at about 70. I think the 500 by so the 500 by 2030 target that leaves us. I think 300 is for solar. We are looking at least we are at, and I'm primarily talking in terms of solar because our focus till date has been largely on the solar side of the business. We are roughly around 70 gigs today in solar capacity in India. We have to take it up to 300, which is a straight gap of about, say, roughly 230. If I use a DC factor of 1.3, we are looking at 300 gigawatt over next 7 years, which roughly gives us about rough number of about 45 to 50 gigs a year, which is a fairly large number. And in terms that any monetary range of anywhere between 200 billion that you wanted to put across, or Subbu reaching up to 1 trillion for the overall sector, I think all the numbers are from a different perspectives are correct. And what we have seen is that in terms of equity coming in, we are still there. There's a lot of interest which is there. In terms of the rate movements in US may have some impact, but we are yet to sort of really see a very large impact on that. What I would rather, because I look at I look at the project finance portfolio as well. I would rather, would like to focus or for the forum to, discuss is that the challenges that the developers are facing in terms of raising debt. And I've been in the sector for some time, been in the larger infrastructure sector for some time. I think the challenges have been there for all of us to see. All of us know the challenges. I think we would need a little more concerted work. And if I may say, a little out of box thinking in terms of the policy action for really, if I may use the word, to opening the, floodgates or the gates for the debt capital to come. Because when you raise equity, it's just 25% work. It's the debt which carries the main burden, carries the 75% of the cost of the project. So I think that would be one area where definitely I feel we have done some amount of work, but that needs some more work to be done going forward.
Thanks, Amit. Before we move on to the sort of debt side of equation, just elaborate a little bit more on the availability of equity or risk capital And if we just stick to let's say a 250 or 300, let's say $300 billion is needed. A third of that is the equity, so 100 billion of equity needed for the sector. Is that available, and if so, where from? Who are the sort of key players? I mean, you don't have to name all the specific names, but just generally, which class of investor is going to mobilize $100 billion of equity capital?
See, frankly, having Avada having recently closed a billion plus of fundraise from two very large players. One, is a very well known. It's a market information. It's a very well known private equity player. The another one is a very strategic energy sector player. So I think it's going to be. And if you have seen the transactions in last couple of years, wherein a large number of players from traditional energy sectors who would like to sort of emphasize on their own green credentials or their green initiatives are looking at India as a fast growing market, which gives them a very stable policy environment, fairly if not world class, but then very close to world class governance standards, and getting clean, platforms to acquire. So yeah, we have raised about, if you look at from 2021 till in last 2 years, we have raised approximately 1.7 billion. We are today at 4 gigawatt. We will probably add up another 6 to 7 gigawatt over the next few years. But having said that, if we in last 2 years we have raised 1.7, I think, say, if I'm looking at anywhere between 80 to 100 billion, there is interest from across the spectrum of investors. Whether we are looking at financial investors, we are looking at strategic investors, where we are looking at, and when I say strategic, it basically from the traditional energy companies who are looking to enter this space. So interest is from a very wide range of investors, and from sovereign funds to pure financial investors till energy companies. So it's a very wide spectrum. It depends upon what is the return expectation a particular class of investor has, or the long-term vision that particular class of investor has. For example, a traditional energy company would have a different perspective when they are making an investment in India than financial investors who has a particular time frame, either with the life of the fund or something like that. So yeah, there is the availability of capital is all across. It is basically putting the both the sides, the provider of the capital and the recipient of the capital in terms of the business model, and then raising the required amount of money. But yeah, I think availability, we honestly haven't seen the kind of interest that we have seen in our fundraise, and in general in the market, we really don't see mm, a challenge, so as to say, in raising equity. Yeah, valuations could be one issue. US interest rates going up could be a sort of a temporary dampener, but otherwise the long-term trajectory remains. That I really don't see a challenge.
Great, Amit. So your bet is, you're saying, largely on the energy company and the strategics bringing bulk of the long-term equity money, followed closely on the heels by the private equity class of investors. So you don't see equity as a challenge, but you raised a critical point on debt. And then let's talk about debt, and I'd like to bring in the sort of three seasoned bankers in the room. Sachin first, Rajiv, and then Giridhar. Gentlemen, where will we find the $250 billion of debt that Amit spoke about?
So, on a broader perspective, to begin with, I'll say the banks have strong interest in funding the RE or RTC projects. I talk about green hydrogen separately on that, because there are different challenges over there. So, as for the banking sector, I mean, the interest is there, but at the same time, the bankability aspects are one important key areas, which banks look at. Now, typically these projects are on project finance basis. So the entire contractual framework, if it is robust, the sponsors' commitments are there. Banks certainly, and the land availability, all those things are there. So banks look at quite positively. They look at RE sector, RTC also quite positively. We've done a couple of transactions recently into the RTC space also. If the entire framework is robust and the bankability aspects are well met, so banks, there's no issue on the appetite. Interest rate certainly depends on the rating and all the other aspects. So in the renewable projects in the past and recently also, lot of strong interest has been there. Traditionally, we have seen that before once a project gets conceptualized, certain and the power sector NBFCs come in, and then later on the refinancing used to happen by the commercial banks. Now, in the past maybe 1.5 to 2 years, we seen that change into that aspect also. So if we have certain percentage of land which is available, so the greenfield projects also financing we've seen happening now, and we ourselves have been involved into a couple of the projects. So if the off-taker is strong, if SECI-based projects, so banks certainly look at different way. If the off-taker is a discom, then certain rating of discom gets impact. But as far as the headroom available, so whether it's tenure of the debt, which is 19, 20 years, we go for that. So that tenure is not a challenge now. Interest rate, as I mentioned, is a function of the rating, and if the project has a some percentage, say 50% is a normal policy guidelines. But if even if there is a visibility of the land getting acquired, and in phases, the disbursements can be linked to it. So on a broader perspective, now the teams in the banks, they understand us quite the sector quite well, especially in SBI. We have a project finance group which looks at these sectors quite in detail. They understand it quite well. So certainly the TV studies have impact. They look at that aspect because the banks rely on that. But at the same time, there's no issue on the headroom for a strong bankable project. So if all the contractual framework is there, clear visibility is there, some plan on the land acquisition is there, so offtakes are there, so then funding is not a constraint. This is to my opening remark. Certainly, each project has to be seen on its own specific merits. Promoters' background also has impact over here in India. Project financing happens in a different way as we see overseas. So those issues also are there, but otherwise there's no challenge as such. But as I said, whenever each proposal comes, we see that independently, and then the call is taken. So we can talk more about specifics also. So I'll say it's a strong interest from the banks.
So no issues on the appetite, Sachin says, and let me bring Rajiv and Girdhar as well on the capacity within the system, and perhaps once they have spoken, Sachin can also comment. Appetite not an issue, but is there enough capacity to lend to the kind of volumes that we're looking at within the system?
So I wanted to kind of just revisit the context, the bigger picture numbers that have been spoken about. I was just doing a few, a little back of the envelope calculations. 500 gigawatts. We're talking about, let's say, around 0.5, $0.6 million per megawatt of solar. Wind will be higher and hydrogen will be even higher. So kind of broadly, the numbers we are talking about is somewhere in the region of a total investment of around 250 to 300 billion dollars that is required over the next 5 to 6 years, of which about at the moment we're talking about maybe 25 to 30% equity requirement, which is in the region of 75 to 100 billion dollars. From a financing solution point of view, there's a few different things that I'm looking at and thinking about, and like a true finance person, I'm looking at multiple different angles. So I'm going to start with maybe a suggestion to the banks that they should potentially think about gradually reducing the equity requirement that the sponsors or the owners need to bring in. Currently, that's about 25 to 30% of the overall project cost. And in Europe, it's quite common for banks to work with 20% equity. So if you think about it in the context of a 500 gigawatt capacity we're talking about, this change, this reduction in the equity requirement could potentially release about 25 to maybe $40 billion of equity that can be deployed in other projects, which will then further, facilitate and help in increasing the capacity. The second aspect to think about is look at ways in which we can reduce the overall capex. Uh, the cost of, let's just say a solar project in India is in the region of around 4 crores per megawatt, which is about, give or take, 600,000 euros. That's about the same or similar cost structure to what you would find in a European economy. But the important thing to note is, Europe includes cost of what is called permitting or a development cost, which is, it can range from around 150,000 euros in Germany to maybe in the region of 225, 250,000 euros in the UK. Now, this is a fairly significant cost, which is quite low or much, much lower in the Indian context. So if we are able to bring down the cost, the capex, on a per megawatt basis by about 10, 15, 20% from where it is today, that further reduces the overall financing requirement and burden. I mean, of course, these are not things that are within the purview of the banks or equity providers, but these are things that will help the sector overall. Now, let me turn to the other sort of thoughts from a financing perspective. One very important aspect, again, in the Western markets and in Europe especially, is the availability of the insurance sector as a potential lender. Now, the big advantage of the insurance sector is the cost of funds is much lower for them, and secondly, the tenor that they are able to look at is significantly longer. For example, from my some of my conversations with insurance companies like an AXA or a Generali here in Europe, you go to them and say, "I want a 5-year financing." They're not interested. You say 10 years, 15 years, they're like, "Okay, we are talking." You say to them, "I want a 25, 30-year financing." They're very happy. Why is that? It's because they're obviously trying to do their asset liability matching. So insurance companies have the ability to take a much longer tenor exposure than a typical commercial bank can. And secondly, the cost of financing is significantly lower. Even today we are talking about a 4% or anywhere between 3.5 to 4% financing cost from an insurance company, which in a commercial bank is impossible. You're always looking at maybe a 200, 300 basis points over the benchmark rate. So the cost of financing from an insurance company can be significantly lower, and that's something unfortunately is missing in the Indian context. And I think that is something, if the regulators can look at opening that. I'm not sure if it was Sachin or Subbu who talked about Amit, I think, who talked about the floodgates getting open. I think this is one thing that will definitely help in opening the floodgates. Another aspect is we need to, I mean, while it's very nice and encouraging to hear companies like Avada talk about being able to raise $1 billion in equity, the problem is the market cannot consist of only an Avada or a Renew or an Adani or a Reliance or these kind of very, very large names. For a healthier, a wider proliferation, if I can use that word, of capacity building, we need to be able to support and encourage smaller companies also to be able to set up and create capacity. Now, they have two forms of challenge. One is their ability to bring the equity, and two is their ability to get the bankers' backing. People talk about name exposure and the name comfort, which is a very important parameter in the banking language. But if you keep going by the name comfort, then you will have a constraint. So one potential opportunity there is credit enhancement. If there are ways in which we can get a credit enhancement structure, which is kind of more routinely brought into the Indian market at a cost, without a doubt, that will be very helpful. So again, taking the parallels from the European market, someone like EIB or any other of the European financing that is available, those are the kind of things that can be very helpful.
So I started my career in project finance and been all through. And today, if you have to look at India, I think most of the financing from the banks are happening in the power and road sector. So the data that is coming in from the RBI, which I was able to see, about 30-35% of the financing that has happened with last 6 to 9 months has been in power. So that's something good, because that shows that banks have the appetite and are able to take things forward. Uh, I would like to draw this parallel from what happened on the solar sector. So when the solar sector came into India, the cost would be 20 crores a megawatt, and then it started coming down, of course, with the capacities getting higher, and and the tariffs started coming down as well. So today, if you look at it, the tariffs are mostly sub 3 if it is solar, and in that region if it is wind. Uh, so that brings in a little comfort from the financiers. So financiers, if you have to look at it, the only thing that they will look at it is how will my money come back. So today, in fact, green happens to be a board level agenda for most of the financiers that are coming in, and access, because ESG is a board level agenda for us. We are ourselves promised that we'll be doing close to 30,000 crores in green financing in the next 3 to 4 years. So in terms of availability of debt, there is something that is there on the table. So Axis is just about 5% of the Indian debt market. So if I have to put it, that Axis would be doing about 4 billion, and you have to make it 20 times. That comes down to be about 100 million. So the Indian banking system perhaps may not be the only way in requiring the debt. But the way I would put it, that it is not that the entire debt of 200 or 250 billion is something that is required from day one. So the way things happened when earlier there were Indian developers who used to put up the plants. Thereafter, we saw foreign players and the venture funds coming in and putting in equity. So I think even hydrogen as a market will play out. There would be actually two plays in it. One would be on the capex cycle. So we would be needing players who would be setting up capacity to supply the equipments. So there would be something on the debt side that they would be requiring. So we have been talking to a couple of players who are looking at setting up, supplying this capital equipments for people who are setting up green hydrogen. And the second, of course, as everybody mentioned, there would be players who would be setting up capacity to produce green hydrogen. Now, from a banking perspective, what is more important is, one, how is the technology? Is the technology that is coming in, is that reliable? Second, in terms of implementation, we all know that a few months delay is something that is typically given off. RBI allows 2 to 4 years delay in infrastructure projects. So delay is something that is of a challenge for both the implementation company and the banks, because that picks up the cost as well. And third is the payment security. So today, even as we talk, today, if the off-taker is a SECI, NTPC, or maybe a GUNL, I would say the Indian banks and to some extent even the foreign banks are happier, because they expect that the money guarantee is certainly there. But if you look at today, the state discoms, when they are actually buying power from the state discoms, there is a kind of hinge that is there from the lenders. So what I like to say is, when we are looking at debt financing, so payment guarantee is something that has to be worked on, and that perhaps that's a larger issue, not only about the industry. Maybe the government can look at some set of a mechanism when we can have some sort of payment guarantee around things. Also, no, things will evolve. So what we have seen even in solar is, while it has not been in that way, there are stronger players who subsequently take over the weaker players. So somebody sets up smaller parks, and there are larger PE funds who would then aggregate it, and then we have seen larger even oil majors, global oil majors coming in and investing into the sector. So perhaps it would not be foolhardy to believe that they would have at some point of time come and invest in the hydrogen sector as well. So while they would have the equity to put in, and even the lenders would be much happier in placing their bets on the projects that are funded by stronger players. Also, in terms, what I like to say is that InvITs may be a play that may come in, and because you have multiple projects in InvITs, and that may come in hydrogen as well. And what happens with InvITs is that your risk gets diversified, and I would say lenders may be willing to put in more money in InvITs because you have a higher rating. Of course, I would say that Indian banking sector is not, perhaps may not have the entire capacity to put in. In terms of DFIs, we have only a few players. Of course, the government is looking at setting up more DFIs, but there is still some way to go. I have seen foreign banks coming in and lending for the some of the solar plays in the country. So if it is hydrogen and it is green hydrogen, I think that is something that foreign banks may come in. But insurance and other players, as Girdhar mentioned, is certainly missing, and there needs to be a reform around it. Because today, if you go and talk to any insurance player, they say, I will put in 20% of what equity has been put in. So if it is a, say, 100 rupee project and you have 25 rupee of equity, they come in with only rupee 5. So that is certainly inadequate given the size that they have. And anyways, Indian insurance play is quite, I would say, bulldozed by one player, and others may not have the capacity of putting in the kind of debt that is required. But having said that, yes, the Indian banks have the capacity. I have seen that people are looking at even foreign place of putting in green bonds. What we are also seeing is RBI came in with this concept of green deposits. And we are hearing that multinational corporations have started looking at placing green deposits. Now, once these green deposits get accumulated at banks, those needs to be deployed into green projects like hydrogen. So I think that would certainly be a fillip, but there needs to be more done also on the regulatory side to push more lenders into this play.
Thanks, Rajiv, for your remarks. And if I may just ask Sachin, Rajiv, or Girdhar, either of you, the question still remains unanswered. Is there, Rajiv, you alluded to it, that Axis will take about 5% exposure of the overall market, but even if you add the top 5 or 7 private sector banks, that's still about 30% of the market, which leaves 70% room. So maybe Sachin can come in. Combination of both public sector as well as then private sector. Do we have that financing capacity of $200 to $300 billion in the system? Insurance, yes, absolutely a big play, but requires some regulatory reforms before, and the risk aversion is deep seated in the insurance sector, right? So it will take time, it will ramp up, but the money is not available today or as of now. So question still, is there capacity to finance the kind of numbers we're talking? Appetite is there, right?
Yeah. So I'll say that yes, the capacity is there for a bankable, robust project which is well structured. So capacity is there. As for the banks are concerned, we've been working along with private sector banks as PSU banks. But certainly, sometime the issues have been there on the way of thinking. But I see that change over there. Now, the public sector banks, their understanding of the sector has improved quite a bit. I can tell about the banks, my parent bank and couple of few banks, public sector banks, which we work. So they understand the sector, but certainly the lead bank has an important role to play always when we talk about consortium financing. So in certain cases, recently we've seen the underwriting options also coming in, wherein the lead bank or has taken done underwriting and downselling happens later. So that has been happening in the recent past. Syndications, we ourselves have been working on it. So syndications is also possible. Yeah, but if the size of the consortium is a reasonable consortium, a well manageable consortium, certainly that partnership of public sector and private sector banks have been there. We talk about other institutions like IFCL and NAFID. So all these new NAFID, they are started picking up a lot of new projects they are evaluating. So certainly we need more of these kind of institutions. With that, certainly the depth of the market is there. Understanding also is improving. Certainly needs to be improved further when we talk about RTC or peak power or even green hydrogen projects. But I think people are looking at it in quite in a positive way. So capacity also, as Rajiv was saying, all these projects will not come in one day. They will come in phases. Although we have strong numbers, but assuming even 30-40% of the projects what we're talking, they actually take on shape. So appetite is not a issue, and so is the capacity. Uh, and something on what Girdhar said, that debt equity issue, which no, earlier we were used to doing debt equity at 75-25, 80-20 is also some projects were done case to case basis. Certainly because of the issue which came into the banking sector. After that, the banks have been little conservative, going up to 70-30. But I think as more and more robust projects comes and which can sustain that kind of debt, I think higher debt equity also could be workable. Another thing I want to add over here is that we have new players coming into the RE sector, which is the public sector companies, primarily the oil sector companies. Now, all the oil sector companies, which primarily have an in-house captive consumption, the refineries, they consume lot of captive power, which they have been using primarily the liquid fuels for doing that, wherein the viabilities are not that great. And now all of them have a target to move out to renewables. So we've seen couple of announcements, couple of MOUs, JVs being formed. So I see that another piece in addition to the private sector players coming up in future, and with the oil sector companies, primarily the refinery OMCs coming up, three or four of them in a big way, and forming JVs or subsidiaries, 100% owned subsidiaries also, to focus only on the green initiatives, on the renewable projects, or on green hydrogen. So funding for them also would be required. And I see from the recent discussion what we were having, for a strong project appetite would be there. So we will see a lot of traction or coming in from the oil sector companies in India, personally from the PSUs. So capacity as for debt funding is, as I said in the beginning, for a robust project it is there.
Right. So still, so Sachin, you say capacity is a non-issue, provided the quality of the underlying credit is high. And there's a question comment being put on the chat room. But are you about looking ahead? Are you talking about capacity on an as-is basis, funding 10 gigawatts a year, or whereas the question we're all asking is, if we multiply that by 5 times, will the banking sector be able to sustain that, right? The supply of credit to the projects, right? So if you do a 5x demand on money, right? Do you have that capacity?
So, see, I think the two measures for there, the banks have been looking at increasing their capital base, and that is one aspect which they are looking at. But at the same time, other international players, certainly insurance sector is one aspect, but other international players, international banks, funding from them, and which we see a couple of institutions looking at India as a growth sector, as a market. So new players, new funding institutions, plus some green lines of credit. Now, in within SBI, let's suppose if we talk, we have we tie up the green lines for long-term funding for renewable projects. So as more and more of that gets tied up, wherein the local bank is doing the evaluation, but back to back, we have arrangement for funds from long-term funds in addition to our own funds. So that also combination is possible. So I'll say that if these kind of capacities have to build up, projects come up, banks will kind of rise up to that, and funding would be available.
So you're saying the construct is there, the appetite is there, and the formula is there, and you will rise up to the challenge and scale as more demand is put onto the sector. So that's Sachin's view from State Bank of India. Amit, do you agree when you're making those applications?
No, I was just while Sachin were talking and Rajiv were talking. So there are a couple of points I wanted to, because I think either Sachin or Rajiv picked up that point. Then in terms of a counterparty risk, that becomes an issue when the lender is assessing. Other than very few counterparties, where are, I would really be very keen to understand if there are major defaults that we have seen in the state counterparties. Why am I saying? Because my portfolio is well spread across from NHPC SECIs to state discoms. We have consciously been away from, say, a couple of southern discoms for obvious reasons. But otherwise, my exposure is spread across all the discoms. But when I go to a lender, and I'm not talking about REC PFC specifically, I'm basically talking for the banking sector. When I go to them, there's a very clear marked preference for a set of 5 counterparties, which is NHPC, NTPC, SECI, and GUVNL. Whereas all the other state discoms are not preferred. Now that creates an obstacle. Now, whereas I understand there are there are some concerns, but as I said, we have to think out of the box. I would really like to know is that have we seen a default from the state discoms happening, especially after the earlier as well as today? There could be delays that can be probably addressed with some structuring around working capital. But if there is no default, but not because the availability of capital between, say, NHPC SECIs and other state discoms is so disparate, and the pricing difference becomes so huge. Because if you look at in terms of a solar project, if you look at the OPEX, heading, the biggest expense that I'm incurring is interest, and therefore I will keep on coming back and with a fine, vision. I look at the cost of capital that cost of debt that I am incurring, and there I think we need to really, sort of look at either new structures or probably start assessing the credit in a different light. Maybe getting insurance companies. I think this insurance sector lending to Indian infrastructure thing has been going on for some good time. We have really not seen it coming in big way. I'm sure there are reasons with it, IRDA for this. But an overall solution has to come out wherein, because if I go to an NBFC, which is a PFC, REC, or a NetFed or a IREDA, all these guys literally are borrowing from the market. They are not the primary generator of debt capital. They are borrowing from the market. They are the secondary sources. The primary source of the capital, of debt capital per se, would remain to be the Indian banking sector, because they are the primary mobilizers of deposits from the public, and that's where the cycle starts. So we'll have to address that level. Also, in fact, we had a meeting with the SECI and MNRE under the green hydrogen mission on Saturday, where an IBA also made certain recommendation or their observation. Wherein Avada also made a very brief presentation. One of the points that we were emphasizing there is that we have seen the entire power sector, traditional, renewable, everything being clubbed under a single power sector umbrella. And given that we have had some issues with the traditional power sector in the past, that overhang continues. I just put it in the comment box also. I just quickly looked at a back of the envelope number between PFC, REC. They have lent to about $100 billion, but it's only 10% to RE. Now, as long as we continue to club RE or say the energy transition sector as part of the traditional power sector, this would always create that bottleneck. Now we have to, and when I keep on, at the cost of being repetitive, when I'm saying out of the box, we have to look at and the Indian banking sector, whether it's through IBA or through a large bank like SBI, or whether that needs an intervention from RBI, then it has to be it cannot be sort of status quo or the way it was going. It cannot be business as usual. It has to be completely sort of revolutionized or a very innovative idea wherein the energy transition is treated as a separate sector, either gets a priority sector tag, or say within the banks, the credit appraisal capabilities are further built upon to, to closely assess the risks which are there. Gagan, I think made a very pertinent point. Are we really there for a 5x jump? We have done this, say 8-10 gigawatt over last year. 5x needs absolutely new ways of thinking about providing this capital. It cannot sort of work the way we have done it in the past. Whether that needs insurance insurance sector to come in, whether that needs emphasis on the capital market deepening. Frankly, infrastructure. I have been hearing in the last 20 years of my career, I've been hearing deepening of capital market is one constant theme, but I don't know when is that real depth would come in, when a project could, approach the markets to raise money. Most of the large pools are either out of bound given the rating requirements. There is no way that a new greenfield infra sector is going to get a AA rating to say tap into the insurance pool. So pardon me for sort of coming back to the debt part of it, because that's what I feel very closely. That's the main driver of capital, because the risk capital is available. There are guys who understand the sector and are ready to commit. It is the debt capital which has to come in to fill the void to really make us achieve the ambitious targets that we have taken as a country, whether in terms of 2030 or in terms of net zero by 70.
Thanks, Amit, and I'll pick on a couple of points made. So I think what you're saying is, yes, on an as-is basis, or if you look at business as usual, that capacity kind of remains. But to deepen the capital pool, banks have to kind of also understand and create the right structures to take on newer, I won't say newer risks, but different counterparty risks outside of those magical five that you spoke of. So one is on the offtake side. You fix the offtake side, and then hopefully that reduction of risk should percolate travel all the way back the value chain. You mentioned, or someone mentioned InvITs at the beginning. So can we not look at, whilst we look at structural reforms through insurance and new products coming into the market, can we not look at products and structures which are prevailing, which is takeout financing through the bonds, through the InvIT vehicles? If a project if money is locked for 10, 15, 20 years, clearly there would be a capacity constraint. So if we are churning capital faster, both on equity and debt side, let's focus on the debt side. Don't you all think we're kind of missing a trick? InvITs provide the right vehicle, both on tax efficiency as well as exposure to institutional capital. And the fantastic news that we heard a few weeks ago about JP Morgan including India on the emerging markets bond index, hopefully should open up starting next year access to green money in the international money market. So aren't we missing a trick on churning capital is the question.
So, no, what Amit mentioned, actually, that's a pain that we hear from all infra players today, that debt is a challenge. So, what I would like to say is necessity is the mother of all inventions, right? So, once there is a requirement, everybody will put in a mind and there would be a structure that would come in. So, we have to also look in what are the challenges on the bank side, and that needs to be taken care of. So if the bank has its challenges taken care of, they would be very happy lending the money to the sector. Now, what does the bank want? One, they want a good sponsor, so they are sure that there would be a good corporate governance, because that's been a challenge in the Indian industry. They want them to be implementing the projects very well. Second, they want a good off-taker, so they take care of the commitments, they take off the power, whatever energy that is required, and they are able to pay on time. I completely agree with Amit also that state governments, the state discoms, because of the delay that has been happening, is where a lot of banks, financial institutions do not want to come in. And
But
because
I'll
banks
just pause
themselves,
here. Isn't that just a working capital product that you put on? Okay, the margins would the IRRs on the project would take a slight dip, but at least it increases the bankability. Why don't we factor in a 9-month delay from the outset?
So, Sanmit, it is not exactly a working capital issue. I would like to see it. Of course, there has been delay, and the delay has gone up to 15, 18 months, right? And the challenge that comes in is not that we know that the money will come after 15 months, is thus we don't know when the money will come in. So there have been institutions that have gone ahead, taken a 12-month Dasra, taken a 18-month Dasra, and done the financing. Now, this is something, as I mentioned, necessity is the mother of all inventions. So they really wanted to do something on the sector. They wanted to do something with that sponsors. So they have come in, put in that mechanism, security mechanism, and they have done the financing. Now, once this is found to be adequate, at some point of time, there would be other investors that would be coming in. Now, two things I would like to put in. So, for example, we have seen there's a pooling that has been coming in. So if you are doing, say, 100 megawatt of a pooled asset, you can have a certain percentage of a state asset also included in it. You can also look at the way InvITs function, right? In InvITs, we have seen that state discom payments have been put into the InvITs. Further, InvITs do allow 20 to 25% of under construction assets to be put in. So there are a lot of ideas. There is no doubt that it will evolve. Things would come in. Things will not happen in the overnight. 2 points I'd like to mention. What Amit mentioned, right? First is putting in the priority sector lending. I think that's a good idea. What the RBI has already done. So any investment up to, I understand, a amount of 30 crores in debt, 15 to 30 crores in debt on any solar project is a priority sector lending. Now that amount can be enhanced, that different methods can be taken in. So that's one area that perhaps regulatory requirement would be there. Second is also what we mentioned of takeout financing. So a lot of we find kind of foreign players in the most of the multinational players, they would do financing through their global lines when it is in the construction phase. And once you have a payment guarantee or payment been seen for the period of 1 or 2 years, generation has been done, they would come to the market and then refinance it for a period of, say, 20, 21 years. So, truly speaking, the market was not a 20-year financing market. It was a 15-year financing market or lower. But lenders have been increasing their appetite, both in terms of tenor and in terms of quantum. So typically when we were doing thermal, we were doing 70-30, and out of 10, that 30, there could be a 10% sub debt. What we have seen that even once a payment track record has been seen, there is a top up that is available to the project. so the equity can be taken out. So I think things will evolve. Of course, there is a requirement of some kind of a regulatory, I would say, foresight to it. Also, nudge to the lenders. I would not say only banks. That would be required. Also, we have to see on terms of banking side. So bank should have a asset, should have a liability to create this asset. So if I have to lend, I must have something that places a deposit to me. So if today a bank doesn't have a more than 5 crore kind of a 5-year kind of a deposit, but if we have to lend it for say a 20-year project, right, there is an asset liability mismatch which the banks have some point of time managing. So they say I have equity, so maybe what I'm lending is through this equity, and there's can be some kind of a mismatch in asset liability that is allowed. There may be a structure that people would finance for a period of 5 years to 7 years, and then it would get refinanced. Maybe you size the debt for 25 years or 20 years or whatever it is required to be, and then do a 5-7 year kind of a structure and then refinance it. What we are also missing out, that mutual funds have not been a big investor in the debt side for renewable plays. So today there are only 3 or 4 mutual funds that invest in bonds for the infra sector. Now that needs to be pushed in as well. So I think there is a lot to be done, but I would again end to what I started it. Uh, Necessity is the mother of all inventions. So as the requirement comes in, I'm sure with the kind of the minds that we have in the India market, we'll find some solution to it.
And then I'll just say that those solutions exist. We just need to stitch them up. The tenor mismatch that you're talking about, or the asset liability mismatch, and Girdhar mentioned why bringing insurance is so important, that they are looking at 20+ year tenors. But if a bank's deposit is 5 years, then it's a very simple product. It's a refi after 5 years, right? And unless we take a serious look at the bond markets, right? And Amit mentioned in my working career as well, Amit, we were just looking at the bond markets deepening. But I think it's a perfect storm, a perfect market forces that are pulling all in the same direction. And with this JP Morgan development, I think the bond markets would be set alight, and one should capitalize on that. But point well taken on the availability of capital. But I think the real issue, the underlying issue, Rajiv, that everyone's talking about is that on the best in class projects would get funded, right? But that's just the 10% of the cream. What happens to the 90%? And those are the ones that are not really getting funded. And that's where we need, and it's not that the quality of the project is poor, it's we need specialist credit enhancement and guarantee instruments and structures to improve the credit rating. And that's not the topic of discussion today. But by and large, the message is the banking sector is kind of 80% there. That 20% necessity is the mother of all inventions, the adage that you use will kind of drive the requisite capital coming into things. But I think the structures are over. I hope all of you will agree that using InvITs, using takeout financing, this is the lowest hanging.
Encouraging and positive to hear Sachin talk about the fact that there is no capacity constraint. But when we look at the numbers, and if you listen to Rajiv and you kind of do the math, it's very difficult to kind of see that as being very obvious. So clearly, we need different kinds of solutions, and I think this is where we need to look at how do we bring in the international markets, the international capital markets into the picture, because there is a huge amount of capital and appetite available both for green and for India, which we need to find a way of tapping. Now, if you look at it from an international investor or international lender's point of view, and I'd like to use the word investor because I think we should now be looking at a mezzanine structure, as I think it was Tarun who suggested that the mezzanine structure is the way, because you have to provide that higher yield to match the country risk and the higher risks that the risk premium that will be expected. The way to do that is, therefore, you have to bring down the country risk in terms of corporate governance. You have to bring down any technology risk. You have to be able to provide that higher yield. So the way to do that is to be able to have some kind of, at least initially, while the international markets develop the comfort, some large players like a State Bank of India or a PFC or an REC or some institutions like that should be able to provide that backstop or some form of credit guarantee, where you're able to package the loans and loans of the different RE projects into bonds and place them in the international markets. That then opens up, it'll give you an opportunity to sell down your debt. So it'll free up people like Axis Bank and other private sector and public sector banks, because everyone has those prudential norms of name exposure, sector exposure, and all of that, which you can't run away from. So the only way to do that is to sell down that debt, and the best place and the only place you can do that is the international markets. The second thing you could do is to bring in some kind of let's say like a yield co structure, which helps to release both the debt and the equity. You bring that, so it's kind of like an equity financing with a debt returns, or a debt financing with an equity kind of return, which will again create an alternate source, an alternate pool of capital for the domestic players, where we'll be looking at something like 12 to 13% or 14% dollar return, which is kind of sitting somewhere in between a typical debt return and a typical equity return. But that's something which will be very attractive from an international investor's perspective. So if we can structure some of those, and then you combine that with an InvIT structure, that is a very nice combination where you're able to provide the lower the risk and improve the returns as well. So let me stop there as two potential alternatives. And I still would say the insurance sector reforms are not as impossible as we are making it out to be. It's a question of a regulatory change, of course, but it can be done if the government is determined to do that.
Great.
Sanmit, I have 2 points to add. Can I make them, and then I think we can open for discussion. So, in continuation of what Rajiv is saying now, and what Amit also mentioned, out of the box thinking and all, I think uh, two things which we have been doing in the recent past is that, let's suppose there's a A-rated discom, and there's a C-rated. At the same time, you have SECI also coming in. So we are having a co-obligor structures, which we are pooling, as someone mentioned about the pooling part. So ultimately, we have 3 or 4 assets coming in one set of financing, wherein the co-obligor structure also comes in. So that way, the projects which I have low rating, they also get financed along with a good rated project. This is how the pooling structure or a co-obligor structure, and has been happening for quite some time, and we done couple of projects under this. Second thing, on the asset liability mismatch part. So recently, on case to case basis, banks have been looking at not as a long term project financing, but first to start with a construction finance, say 3 years loan or 4 years loan, and it is not categorized as a project loan. It's more like a construction finance. Certainly, sponsor sports, or they also have to be seen in some fashion. But after that, 3 or 4 years, when the project is stabilized, you can go for long-term financing, or you can go to a bond market, because by that time the track record had been there. You can get good ratings, so you can access the market. So rather than long-term financing, some kind of construction finance, which we started doing in some of the public sector projects, PSU projects or joint venture projects or PSUs. But going forward, I think with stronger private sector players coming in, that another product is something going to be available, wherein you get a financing right now, say not categorized as project loan, but later on you refinance that either with loans or with the bond market. So these are two new, I will say, structures which certainly had been there, but they are evolving for the RE sector.
So all of you are generally leaning towards the takeout financing, right? So I think that's perhaps the easiest and fastest way to bring that additional 20 or 30% liquidity whilst the structural reforms are happening in parallel. So that's the sort of overall message.
Aditya from Bhushan Energy. What I was thinking is that while we are discussing that how to flex the parameters under which the financial industry already operate, like by saying that if we can reduce the equity requirements or if we can increase the other aspects which will immediately attract Basel 3 or Basel 4 requirements for the sector, banking sector. I was thinking that is it possible to um, divert money from other industries where the money is getting invested in, be it pharma or be it other sector, and make energy priority one, so that the money comes in without compromising on the banking norms.
So if I understand question correctly, Aditya, you're saying put energy transition as a broad bucket in the priority sector lending and not just individual
Yes,
subsectors, right?
yes, please. Yes, yes. So,
Yeah.
so as we can see, there are about 9.6 trillion assets under control. If we just take example of BlackRock, a lot of that money is going in different sectors. If you look at, if you do a sector analysis, portfolio analysis, and try to see that while they remain within their financial prudence norms, how could that money, which is going into, say, a lot of money is going to AI, which doesn't meet a lot of financial prudence criteria, or maybe to fashion industry, clothes industry, how could we bring that money more towards the capital sector building up, be it infrastructure for energy?
Point noted. I think Amit mentioned that right at the outset. Any comments on this, on how do you bring energy transition as a new category under priority sector?
Just if I can add, so as I'm sure the forum is aware, so in terms of the categorization of the sectors, there are two parts. One is obviously from a banking perspective, RBI would have to do it. The other part is that the harmonized list that the government of India, the Ministry of Finance, comes out with. So I think it has to be an absolute, both these entities will have to, it has to be an absolute unison and same time when they work. That's I think one of the key demands that we made in that green hydrogen meeting with IBA as well, is that this classification we will have to look at energy transition as a new sector requiring a new way of thinking. So I think both we and that day Sajay Yadav, who is the JS for hydrogen mission, he was there. Said that that's something that we should work on. So I think this both the reclassification part will have to be dealt with in terms of IBA would have to sort of lead it on the bank's behalf with RBI, and as an industry body we work with SPDA and say other entities like GH2. We'll have to run it towards the government to get an action, initiated on this particular part.
I think that's a great point of follow up for all of us to start this the jungle drums on the reclassification of energy transition as one having its own unique financing requirements, right? And they can't be just clubbed with plain vanilla solar or or other projects as such. So thank you for that point, and we shall definitely follow up on this. Gagan, you had a point to make.
Yeah. Thanks, Amit, and really interesting discussion. I think a lot of things that we sort of think of and look at the Center for Energy Finance, obviously being brought up here. I just want to pick up a point that Amit mentioned, and I mentioned in the chat box as well. Amit, sorry, I wrote Arjun, but I meant to write Amit up there. But on the credit ratings, so it's our view as well that the loans have actually performed quite well. Loans with solar, wind underlying, and I suppose the question to the bankers in the house is, what has been their experience on the NPA front with their sort of loan books, towards renewables. So that's one question. And I'd like to also make an observation that, on the recycling of the loan books, we feel that the domestic bond market is perhaps more suitable than the international markets simply from the currency mismatch perspective. And whilst a credit enhancement solution has been on offer or available on commercial terms in the market, the reality is once you factor in the pricing of that insurance or the wraparound, it becomes prohibitive. So I think we're actually at a stage where these loans are within, I would call, sniffing distance of getting to the market unsupported, but with a little bit of a nudge, and that nudge being priced on actual credit history rather than sort of perceived history is what can take them over the edge and into that bond market. And then if a few other things were done to sort of complement that. So, it's not enough to have domestic pools of capital looking at this, right? You also want to have the bond market be a window of international capital that is looking to access the Indian market. So just like the sovereign green bond issuance was done under the FAR route, corporate green bonds should also be fully accessible, because that's how you get international capital. Otherwise, it's just capital circulating in the Indian system. The second is, you want to also have green mandates for some of the large Indian institutional investors. Think of pension funds, insurance companies, mutual funds, at least the first two anyway. And lastly, some sort of measure of hedging protection for those foreign investors, right? Because if they're putting in dollars and taking rupee exposure, they're holding the can on foreign exchange risk. So how do you sort of price that in? So I guess the question is to the bankers, how has credit performed? And the observation was on some of the things that can be done to get this paper onto the domestic bond market.
See, typically banks had not been very large lenders on the renewable space. So yeah, wind and solar, what has been there, they would have been only doing it incrementally over the last decade. Wind, the challenge that has been faced by bankers is that the wind pattern itself is changing. Now, wind, you can primarily do it in 8 states in the country and no more. Last 4 years, uh, I hardly know a project that would have done P90. A lot of them are below P50 levels, so cash generation because of last 3-4 years, and we know that El Nino effect and other things that are there, that will have a large variability on wind projects. So what we are seeing that a lot of banks are cautious even doing wind, right? Solar side, there has been generation has been more stable. It is only the payment risk that the bankers fear. So SECI NTPC projects have not been a challenge, and that's where you're finding that greater acceptability has come in. And let me tell you, this has been built over a period of time. So, acceptability, say a 5-6 year back, was much lower than what it is today. Today, SECI NTPC will perhaps just fly off the shelf. It's only the interest rate and the structure in terms of equity and pricing that is to be put in. So, experience, if you ask me, because bankers burned their fingers on thermal, they had been more cautious. And my sense is, and I can certainly say in terms of access, that experience in whatever we have done in renewable is pretty good. Now, even within renewable, there are what we do with, say, SECI, NTPC under discoms, and there is also a CNI segment. And my friends who are there on the corporate side, they would find that even what they of course get a better yield in CNI segment, but banks coming in to finance CNI segment, again there has been a little reticence on there, but people are incrementally going and doing that. Now there's a thought that comes to banks is today if there's a end user which is say a triple B rated who is signing the PPA for the CNI, would I give him a 15 to 20 year loan? And the answer would be perhaps be no. I may give him a 7-year loan, a 10-year loan, but I perhaps may not be giving him a 15 to 20-year loan. So if I can't give a direct 15 to 20-year loan to this corporate, can I give it to the SPV that will be supplying power to them? So those are questions that have been coming in. These are things to be solved, and as Samit mentioned, refinancing, structuring is something that will come in, and maybe putting some of them into InvITs. Uh, uh, that's one piece that is there. In terms of bonds, there are rupee bonds that can be done, Gagan. So they are what we call a masala bond. They are rupee denominated. The window is not open all the time, right? So depending on the
Mark,
returns,
the mark is very shallow on masala
very
bonds.
sure. Yeah, that's what I'm saying. So once in a while, you may have Sanmit as a good issuance that is there, but right now it is a no go. But you may have opportunities, window opening up, and people have to be ready to go and tap it. While foreign equity is coming in, we have not seen foreign debt too much in a flow, but we have seen MNC banks do coming in and lending to this sector, right? And there is a corporate green bond market. Axis was the first bank to raise green bonds internationally. So there is a market, but if you ask me, if I raise too much of a money, am I sure that I'll be able to deploy it? That is a question that I have. And second is, of course, my own risk appetite measures that would be required, because end of the day, the credit risk is on Axis Bank, irrespective of where do I raise my liquidity from. I hope I answered most of your questions, Gagan.
Certainly, I also agree that the exposure of banking sector to renewable has been limited earlier. Banks, whatever they have participated, they've been participating more on takeout financing or refinancing for the completed projects earlier. Now, in the recent past, in last couple of years, they've been looking at projects, renewable sector primarily on the project financing basis under construction projects. So this is a new trend which has come from the commercial banks now. So it's a investment cycle starting. So we have to see, although the banks are more cautious, the guidelines are quite robust from that point of view, from the experience what they have been there. So the experience has been good so far, as far the renewable sector is concerned. As for bond market, also again the depth is not there. So if the rating is A, the interest rate or the appetite from the bond market is not there at all. So triple A or sometimes double A rated bonds, the appetite is there. So primarily the bond issuances are for triple A and very few for double A. So to enhance that structures, could be you go for construction finance, go for 4 5 years of loans and do the refi later. So what I was saying, I was talking about the bonds market per se. So as I said, the appetite is there for triple A rated or double A rated bonds only. So for a new project where the rating is triple B or A, the appetite is not there. To overcome that, could be you go for construction finance, go for 3 4 years of loans and refi it once your rating improves, and go for the market. But still, the market is not that the appetite is not that great for even for a double A rated bond. So 500 crores, 600 crores is fine, but beyond that is challenge. So the bond market is primarily for triple A rated borrowers right now.
So there are some pinch points in the financing, Sachin, that you mentioned to Gagan's question. So Gagan, a follow-on question or more comments?
Yeah, thanks. One more sort of follow-on comment to what Rhythm mentioned. Rhythm mentioned on the thermal loan experience of banks, right? So I think it's my view that renewables tends to be unfairly tarnished by that experience, not really recognizing that there's some clear differences between thermal and renewables. I'll just give you a broad example. I think a lot of the reasons why thermal loans went bad was because loans were extended without PPAs in the first instance, a lot of times without PPAs and coal linkages, and then you had cost overruns of pretty eye-popping cost overruns. So suddenly you shift to, let's say, renewables, where I don't think any financing is done without a PPA. Second, whilst there is variability in solar insulation or wind, Rhythm was talking about how the experience of wind has been perhaps lower than they expected or modeled at the time of sizing or pricing the loan. The reality is it's not an all or nothing thing, right? It is there. And third, I think on the cost overrun basis, pricing of modules and turbines is fairly transparent, So the reasons why thermal loans went bad in the past, I think, are reasons which are very unlikely to repeat for renewables.
And again, it's incumbent upon all of us, Gagan, to educate the banking sector on what are the differences between thermal or other forms of energy projects and renewables, right? So those nuances have to be brought down, and I think there's enough understanding now in the sector. Perhaps there are structural products that need to be introduced. So one area we've seen as a pinch point is the beyond the Magic 5, the rating of the discoms, right? So whilst there hasn't been a default, and that's what Amit was asking, then why are the banks not lending? Yeah, one or two odd cases which are outliers, and that's true for any market, right? Where the payment cycles have stretched beyond a year, but by and large, the discoms don't default. And they'll definitely delay. So that's a structural product. I want to introduce a new structural product, which is a currency swap, right? So a foreign exchange swap, which India had tried out with Japan. Japan still being the lowest cost of money compared to most economies. So this is definitely on the anvil amongst all the DFIs and multilaterals, that the institutional money globally is at $100 trillion plus, right? And why is that institutional money not getting into emerging markets? And I think this could be perhaps a golden moment, given the the inflationary environment that we are in, particularly due to interest rates. A discussion and dialogue we've been having, that a UK or a European solar or a wind asset which is yielding 5 or 6%, why would any investor put capital in that project when Bank of England or US T-bills are also offering similar yields? So and if India is able to offer 9 or 10% yield, then it becomes a very, very attractive proposition, right? So perhaps we have a 2-year golden window to be able to tap into institutional money around the world. FX risk notwithstanding, we definitely know of that as an issue, but there are products. So another product is looking at wholesale sort of FX hedging product, where 10 plus, 15 plus year hedging products are coming on the radar. So there are 3 or 4 institutions ready to offer 10-year forward hedge for INR USD or an INR GBP swap. So these are new structural products also coming on the anvil. So if you couple that, these products along with the institutional money outside, I think we are in for a bull run. But it will require stitching up all of these instruments together. So I just wanted to introduce that into the mix of things.
No, just a small point, in fact, adding to what Gagan was saying, in terms of, if you look at the cycle that the traditional or the overhang of the conventional power sector, that run started somewhere around 2000, had run its course, faced the troubles by say 2013-14. And if you look at startup of solar story in India, say if I say JNSM, till now we are in that 13-year, we are in the end of that period. The sector has not seen those challenges that the thermal story faced, because as Gagan said, there were some fundamental issues there, which thankfully this sector has been able to identify and probably learn from the past. Lessons have been corrected from the word go. So I think now it would, and I'm coming back to and exhorting Sachin and the banking sector to look at RE as a different animal with different requirements, and help us create that pool that all of us so desperately now need to tap to really achieve that ambitious target.
Sure, Amit, and I'll just like to add here is that see, you must have seen a change in the last maybe 1 or 2 years, how the banks look at the RE sector. When during COVID, all the new projects started coming. I mean, after COVID and all that time, that the outlook was different. As I said, some banks were doing only takeout financing, not into the greenfield projects. Now the understanding has been improving, confidence has been increasing. So from that point of view, a lot of new greenfield projects are there. Certain projects on RTC also now have been done. Peak power also have been done. So green hydrogen certainly is different animal altogether, I'll say, because of the offtake issues and affordability issues. But talking especially about renewable energy projects, I think banks are kind of updating themselves certainly and have strong interest. So they have appetite and they're looking at a different way which they used to do, I think, 2 3 years back.
No, I'm completely agree. On a disclaimer, as I said at the start, both SBI and Axis are our lenders, and as we speak, we are negotiating term sheets with them. So no complaints there. But as a developer, we would always appear to be very aggressive when if I may use the Pepsi word of saying "ye dil mange more," so we always are hungry for that capital,
Yeah,
and hence
so
we would
pricing is
always
always
appear
a
that we are
challenge.
pushing.
Yeah,
But surely, we definitely look forward with the banking sector
yeah,
to
yeah.
work
Just
together.
as you said, Dil Mange More pricing is the only challenge in most of our deals which I've been doing. So that is a
Surely,
discussion
surely.
point. So otherwise,
Yeah,
projects price they have strong appetite.
sure.
Yeah.
So, Samit, I think I like what Gagan said earlier, that we are within sniffing distance, from being able to get these financings and the projects sort of bankable in a sense. The important thing to recognize from everything that has been said is, we're looking at against the requirement of about 50 gigawatts per annum capacity creation, to reach the target. It looks like we have a solution in the domestic market for about maybe 20-25 gigawatts, not significantly beyond that. If we have to go beyond that, if we have to recognize or realize this thing about being within that sniffing distance, because the last mile is always the challenge. The key thing is to be able to tap the international markets. And for you to be able to do that, the exchange risk is, of course, one very important thing. The country risk is an important thing. How do you sort of manage these risks? The corporate a borrower, if it's someone like a well-known name, a large name like an Avada or a Renew, they probably will have the opportunity to tap the international markets on their own, but not everyone can do that. And like I said earlier, if you want to be able to achieve this goal and target, you should have a proliferation. You'll have to have multiple people being able to set up capacities, which requires a wider market and being able to finance it. So the international bond market, the international markets, from a, call it a mezzanine market or a bond market or a yield market, these become very important. And for that, you will need to be able to provide some kind of a backstop or some kind of support. Insurance is a great product, but the wording and the conditions, the problem is in the Indian market. My experience has been that insurance always finds some kind of loopholes and some kind of outs, not to make the payment. So you end up spending all that money in taking out an insurance wrap in the first instance, and then you don't actually get it when you really need it. So it's very important that we find an alternate mechanism or a mechanism that will work. So that is very, very important. So I go back to this point about the equivalent of an EIB kind of a structure, something equivalent to that. So if an REC or a PFC can be that kind of, or if a SBI can be that kind of a thing, so SBI can, in a sense, buy the loan book from the other different banks, aggregate that, and then sell it down in the international market, keeping the first loss of maybe a 5% or something like that. That way you are opening up the market, you are significantly deepening that market that is available. Like you've said, for the last 20 years, I think I have been hearing about the Indian bond markets the capital markets for the debt side deepening, it hasn't happened. We've had any number of sessions with the RBI, the Ministry of Finance. I mean, there are challenges, and which is why I go back to that point about insurance. I think opening the insurance, the tweaking of that regulation, which allows an insurance company to lend not as equity. Don't lend as equity. You lend as a senior debt. I mean, it's as low risk as you can get. Well, relatively, right? So I don't really see a problem in being able to facilitate that insurance market getting opened up in the domestic that will open a huge pool of capital. So together, the domestic insurance market, international bond market, I think those are the two things that you will need in addition to the existing whatever solutions to be able to hit that 50 gigawatt market. And we're talking about 50 gigawatts requiring this 200 or 250 billion dollars of capital, and this is just for the capacity, the core capacity. We're not talking about green hydrogen. We are not talking about any other interconnection transmission requirements. We're not talking about storage. These are additional requirements. This will potentially add like $100 billion additional on top of all of this. So we clearly do not have the domestic solution. That is what we have to accept and recognize. And only then will we really be able to find the right kind of solution.
It's in terms of, apart from the pure PF, there is a huge amount of non-fund based working capital limit that I need. When I'm bidding for the project, when I'm winning the project, I'm not even going in terms of my import LCs, etc.
So you mean the guarantees and instruments, right? The bank guarantees and the MDs, right?
Yes. So, that's one product which we have, because it's unfair for us to ask the banking sector to provide everything. And I feel a non-fund based facility, especially for BGs, is a pure wastage of a banking line. Now, 3 years back, we started with the surety bond product. We're still, figuring out how to go about it. I think the first one is coming up only for NHI. We are somehow, meandering in the bureaucracy, wherein the beneficiaries are still not accepting that as an instrument. Now, I think that's where we need to really focus, because that's a substantial part for a project. On an average, I end up blocking for a 200 megawatt project. I will end up blocking some 20-25 crores of limits. So 1 gigawatt result into 100 crores of limits, and these are long term. At least 3-4 years, the money gets blocked, and it's the banking, capital, wherein the capital gets stuck for the bank, and it's an issue for them in terms of the overall ability to lend. So if that piece can move out to insurance companies as a starting point, wherein we are not able to get insurance to lend us long term, fair enough. Maybe get them to come up with a surety bond product. I think recently IBC has done some changes. We should see, but the only point is, as a developer, I think in my earlier role, while I was in a different developer about say 3 years back, when FM announced surety bond, I had taken it as a KRA. No, we want to be the first one to issue a surety bond. Never happened. It's been at least 2.5 years since we are waiting, and only one product which has come up. I think HDFC Ergo or somebody has launched one only for NHI. So I think that piece is also there. Could be a low-hanging fruit wherein MOF, MOP, everybody's aligned. It's just about the insurance regulator needs to allow the products and the beneficiaries accept it. And I think banking sector will get a respite, because if suddenly today I run a working capital program of almost 2,000 crores, and it's primarily focused on BG. So if I can knock off that capital, is it then available? It's a small amount, but then it's available. When you aggregate all the developers, that suddenly becomes a very large amount, which can then go towards the sector as the long-term project finance facility. So I think there are multiple ideas. I think we need to sort of list them out, look at what is low-hanging, work on them immediately, and then try and address.
No, that's great, Amit. I'll for the benefit of everyone, some of you have heard from us in the past. So what we have done is created a library of structures and instruments, more than 35 structures and instruments that have already been identified. And if you look at any of the the past workshops, reading and summary materials, you will find a link to that. If not, just give us a shout and we'll share the slide with you on what those instruments are. And so it's not that we are trying to reinvent the wheel. Every bit of a solution, whether in form of product innovation or a new structure, exists. We just need to find those use cases and start applying those structures and instruments to get the the markets moving. But I would say by far the largest structure instrument that'll move the needle is the takeout financing, right? So you free up more capital, and to your point on surety bonds, free up that capital for me. Why should I block that money for no good reason, right? And it's not productive money. It's essentially just a safety in the back of the mind that the developer has some skin in the game, right? Over and above the equity capital that the developer is putting in. So point very very well taken, Amit, on that.
Surety bonds have been a reality on road projects. So I think just doing it in power projects is to be done. Two more thoughts that are there. So if you look at EPC contracts that a lot of government-owned companies have come in, especially on the oil sector, they have reduced the quantum of BGs that are required. Now, perhaps there may be a case of looking at the quantum of BGs that the sector needs to put into, say, a SECI, NTPC, or anybody who's trying to put in. So that's one thought. Second is one piece that is also being doing the round. So banks, while they do allow DSRA to be replaced by a guarantee, it is to be done by a bank guarantee, and such bank guarantees are very rare. So Amit will perhaps agree to that. That I can take that amount. Whether we can have besides bank, we can have, say, NBFC or insurance company or somebody doing two pieces. One, guarantees that are going to the regulators or the off takers, or just removing the DSRA with the guarantee from an NBFC or somebody else. So that will may not be a very large piece, but that can bring in some additional financing into the sector.
Well, we had a fantastic discussion. I think covered quite a lot of ground in terms of where are the challenges in financing renewable energy, I am conscious, and this was deliberate. This wasn't really about financing green hydrogen, because that's the entire series of the workshops that we are doing is looking at how do you finance green hydrogen, because there are larger issues, larger risks that have to be mitigated or addressed and quantified on the green hydrogen side. So the sum total of all of these workshops will give us the answer on financing green hydrogen. Today, we just wanted to concentrate on the renewable energy sector, which has the single most significant influence on both bankability and the cost and price of hydrogen that is produced. So we have in our research, we identified capital supply as a big constraint to the RE sector. So whilst the appetite is not an issue, the understanding is improving on a daily basis, but there are structural faults that prevent the sector from that bull run that's needed, or 5x quantum leap that's required in capacity addition in the next 3 to 5 years that Subramania mentioned. So as I mentioned a few minutes ago, takeout financing will be one of the biggest movers and shakers in the market, and all of us must look at that. But some very interesting ideas about DSRA getting replaced by bank guarantees, surety bonds getting replaced by or getting accepted as a norm, bringing energy transition into the priority sector lending criteria, looking at FX swaps as again a macro product, not a corporate product. That product exists, but a macro product where governments can do balance sheet to balance sheet facility creation. And finally, looking at structural reforms on how do you bring more insurance money to deepen the capital pool and kind of jumpstarting the Indian bond markets is some of these solutions that were addressed by all of you. So we will, like we've done in the past, we will do a summary of this particular session. Video recording will be available for you to go back and have a look at what was discussed and jog your memory again. And as Nish mentioned, my colleague Nish mentioned right at the beginning, we run these workshops every Wednesday. So do look at the agenda for the next workshop, which is essentially going back to the green hydrogen. How do you develop what's called a hydrogen bank in Europe? How do you develop an equivalent structure in India? Not just a market aggregator, but a market maker. So a market maker takes those risks on pricing mismatch, on volume mismatch, on tenor mismatch, and focuses on bringing liquidity and creating the market. And we'll touch upon a number of other structural instruments like carbon financing as part of the market making exercise. So that's the topic of the next workshop. And finally, 28th, 29th of November is the Climate and Energy Transition Finance Summit in New Delhi. So the details of that will be going out very soon. Do mark your diaries for that event, and would love to have you all participate there. And that'll be one of the most significant events that we're doing along with the G20 Secretariat just before India passes the baton on to Brazil, and coming close at the heels of COP28, which starts on 30th of November. So on that note, thanks to all my lead discussants, Subramaniam, Sachin, Rajiv, Amit, and Giridhar, for your wonderful contributions. Thanks to all the participants for making the discussion exciting, and your comments and suggestions and questions are always welcome. If you still think there are one or two left that we haven't answered, please send us an email or a message, and we'll get back to you very soon.